no tax on tips, no tax on overtime, and no tax on Social Security. You've probably heard these headlines over the past few months and may be wondering how exactly they all work. These are all new tax provisions from the One Big Beautiful Bill Act signed into law on July 4th, 2025. And in this video, we're going to dive deeper into the new changes and how they actually work. Hi, my name is Vasily Zois, and I am a fiduciary investment, tax, and insurance advisor with over a decade of experience helping people eliminate the stress and avoid costly mistakes associated with their taxes. When the One Big Beautiful Bill Act was signed into law last year, there was a ton of both positive and negative coverage about this bill. But putting political views aside, I'm here to share how the new tax changes actually work and how they may affect you. The first big change was no tax on tips. Effective for tax years 2025 through 2028, employees and self-employed individuals can deduct qualified tips in certain occupations listed by the IRS. These occupations must customarily and regularly receive tips, which means you can't just say all of your income is now tips. Qualified tips are labeled as voluntary cash or charged tips received from customers or through tip sharing. Some examples of jobs that would qualify are food and beverage services, think restaurants and bars, entertainment and events like gambling personnel or content creators, hospitality and guest services like bellhops and housekeeping staff, home services, which would include home cleaners and maintenance workers, personal services like tutors or babysitters, personal appearance and wellness like massage therapists and hairdressers, recreation and instruction like tour guides and personal trainers, and transportation and delivery like shuttle drivers and parking attendants, just to name a few. This deduction is available regardless of whether you itemize your deductions or claim the standard deduction. The maximum amount you are able to deduct as tip income is set at $25,000, and the deduction phases out for taxpayers with modified adjusted gross income over $150,000 if you are filing single, or $300,000 for joint filers. To claim this deduction, you must include your Social Security number on your return, and if you are married, you must file jointly to claim the deduction. The second major change was no tax on overtime. Effective for tax years 2025 through 2028, individuals who receive qualified overtime compensation can deduct the pay that exceeds their regular rate of pay, more specifically, the half portion of time and a half that is reported by the Fair Labor Standards Act and is reported on their W-2, 1099, or other tax statement or documents. Workers must be non-exempt employees who are often hourly workers, but the Department of Labor considers some salaried employees earning under $640 per week to be non-exempt as well. So make sure to confirm with your employer if you are exempt or non-exempt for overtime. This deduction is available regardless of whether you itemize your deductions or claim the standard deduction. The maximum amount you are able to deduct for overtime pay is set at $12,500 for single filers or $25,000 for joint filers, and the deduction phases out for taxpayers with a modified adjusted gross income over $150,000 if you are filing single or $300,000 for joint filers. The qualifications to claim this deduction are the same as no tax on tips. You must include your Social Security number on your tax return, and if you are married, you must file jointly to claim the deduction. The third change that will benefit taxpayers is no tax on car loan interest. Effective for tax year 2025 through 2028, individuals can now deduct the interest paid on a loan used to purchase a qualified vehicle. The vehicle must be purchased for personal use, and the IRS's definition for a qualified vehicle is a car, minivan, van, SUV, pickup truck, or motorcycle with a gross vehicle weight of less than 14,000 pounds and undergone final assembly in the United States. Leased vehicles do not qualify for this deduction. This deduction is also available regardless of whether you itemize your deductions or claim the standard deduction. The maximum annual deduction is $10,000 and is phased out for taxpayers whose modified adjusted gross income is over $100,000 if single or $200,000 for joint filers. To claim this deduction, you must include your vehicle identification number, or VIN, of the qualified vehicle on the tax return for any year you wish to claim the deduction. One change that is particularly exciting to retirees is the extra deduction for seniors. Unfortunately, the no tax on Social Security didn't fully work out, but this is an alternative. Effective for tax years 2025 through 2028, individuals who are 65 and older can claim an additional deduction of $6,000 per eligible individual, or $12,000 total for a married couple where both spouses qualify. To qualify, you must reach age 65 on or before the last day of the taxable year. This deduction is available regardless of whether you itemize your deductions or claim the standard deduction. This deduction phases out for taxpayers with modified adjusted gross income over $75,000 for single filers and $150,000 for joint filers. To claim this deduction, you must include your Social Security number on your return, and if you are married, you must file jointly to claim the deduction. These were the four main talking points of the One Big Beautiful Bill Act that got most of the coverage. But some other notable changes include increased child tax credit from $2,000 to $2,200 per qualifying child under the age of 17, which reduces taxes owed or provides a partial refund if the credit exceeds taxes owed. Number 2, partially refundable adoption credit of up to $5,000 per eligible child. This credit can only reduce your tax liability. It cannot result in a refund. The non-refundable portion of the credit can be carried forward for a maximum of 5 years. Number 3, Trump savings accounts for children, which are a new type of IRA for children. Parents can file Form 4547 with their 2025 returns to have the IRS create a Trump account, and the U.S. government will deposit $1,000 for each eligible child born between January 1st, 2025 and December 31st, 2028. The One Big Beautiful Bill Act also provided some changes that affect businesses. Some examples are bringing back 100% bonus depreciation on assets, bringing back expensing certain R&D costs, 100% expensing for certain U.S.-based manufacturing structures and facilities, increased the Section 179 limits to 2.5 million and the phase-out threshold to 4 million, permanently reinstating the higher Form 1099-K reporting threshold, which means third-party settlement organizations like Venmo and PayPal only need to issue a 1099-K if a payee exceeds $20,000 in gross payments and more than 200 transactions. And also increase the threshold for companies issuing 1099 miscellaneous or 1099 non-employee compensation from $600 to $2,000. Hopefully this video helps you understand the tax changes that the One Big Beautiful Bill Act brought and how it may affect you personally. If you enjoyed this video, please subscribe to the channel to learn more investment, planning, tax, and insurance insights. If you have any questions or would like help preparing or filing your taxes, there is a link in the description of this video where you can schedule a time to talk with me directly for a free, no obligation meeting. Thanks for watching.